This conference will now be recorded.
Okay. Okay, guys. So before I start off, I can see someone called Janet Johnson being in the list of the participants. Who is that? So have you entered some other email ID to join the session, or is that some other separate individual? Okay, fine. Okay, fine. Fine. So while we have been talking about the the linear regression model at length, so in today's discussion we'll focus on the key uh, dependent variables, right, which satisfy or which to which linear regression is applicable. Now, one of the very important, so basically we'll talk about. So if you think about it, we'll talk about applications of linear regression model to risk. Now, while I talk about these applications of linear regression to risk, there are a few important, so there would be three key topics that I would be discussing over here, and I'll be telling you how is it that linear regression gets applied over there. So let's start talking about the same. The first that we need to talk about over here is the stress testing frameworks, the stress testing models. So under stress testing regulations, we'll talk about CCAR and DFAS. So I'll just give you a brief about stress testing, right? And then we'll talk about how is it that linear regression gets applied to stress testing, right? Now, talking about stress testing, and when I talk about stress testing, there would be two regulations that I would actually focus upon. So one is CCAR and the other is DFAS?
Sir, I think DFAST has been closed right now. Now there will be no DFAST regulation will be there. It's a current
Yeah, so
news has
maybe.
been there. It's this year.
Yeah, so that is possible, even though I was not aware of that because I don't work on the American regulations. But the importance of DFAS comes from from the stress testing regulation, from the internal scenario design perspective. So that is all I would be focusing on for DFAS. So even for me, DFAS does not have much of a significance for a large bank when you have CCAR, because CCAR is something which is uh, the universal stress testing regulation that is followed under the Federal Reserve. So but the entire idea is just to talk about the internal procedure of scenario design and so on. So anyways, I would not be talking much on the regulatory side, but more on the statistical side of this. So and just a few basic differences just to understand why was CCAR important, even though DFAS was there at the point of time. So that's the application. That's the relevance of DFAS for our present discussion. The second set of models that the second set of model that we'll talk about over here is the loss given default models. The loss given default models. Now, when I talk about the loss given default models, it is not always that the LGD model is developed using linear regression only, right? So there can be other methods of developing an LGD model, but we'll refer to that version of LGD model which we use, and how would the dependent variable look like, and so on. Okay. So two broad regression models which are used to develop an LGD model are: number one is a linear regression, and that is why I have put this under this regression framework. And the second that I have over here is the beta regression, which is really followed under. So if the LGD distribution is a steady skewed distribution, that is where we talk about the beta regression. Okay. The third model that we'll also get to see over here is the EAD model, or as we call the exposure at default model. Exposure at the exposure at default model. Now, given that the exposure variable is a continuous variable, so you can think of using the exposure at default. But when again I talk about exposure at default models, there are two types of models which comes in. One is the LEQ models, the loan equivalent models, and the other is the CCF version of the EAD models. CCF stands for credit conversion factor, and this CCF is very or it's used very aptly for your revolving products. So the products which come with a limit and a balance, like a credit card or any kind of commercial cards, etc. So which has a revolving line of credit. So that for that CCF has to be calculated, right? Now calculating, so talking about CCF calculation is uh, pretty normal. So there are certain formulas following which you can do it. And if you are trying to estimate the CCF, your CCF can be estimated using a decision tree framework, or a linear regression framework, or even your logistic regression framework. So depending on the way we are trying to frame the particular model. right? But mostly because an exposure at default, you're trying to estimate the exposure which is there, the outstanding exposure. So from that perspective, a linear regression or a continuous regression model becomes very handy. Right, so these are the three kind of case studies that we will be talking about. And in CCAR, or in while talking about stress testing, the version of the model that we will be, or the part where we'll talk about the application of linear regression is in regressing the dependent variable or in relating the default rates the default rates to the macroeconomic variables. Rates to the macro variables.
Tanmay, please repeat this. What did you say? Like CCAR and DFAS that relates to the default
No, no, no,
relating
no.
default.
So basically, no, it's not CCAR and DFAS. So the role of regression or linear regression comes in when you are trying to relate the default rates to the macroeconomic variables, right? So this is one of the part that with which we will start our discussion with, right? So we'll talk about how exactly a stress testing is done, what exactly stress testing all about, right? And from there we'll see how linear regression gets applied. So where is that part where regression is applied, and what are the challenges that you face when you are developing this, or when you are trying to develop this kind of a model, right? Or the stress test when you are trying to develop these basic stress testing models. So we'll start off our discussions from that point. So before we talk about linear regression or we talk about CCAR or anything, we'll start off the discussion with stress testing. And the question that comes out over here is, why stress test? Why do we need to stress test our capital requirements? Why is it that, so why would we need it even after we have the capital adequacy Basel Accords, right? So that is the point that we need to really talk about. Now, stress testing is required to ensure that, or to be kind of a double sure, right? Now, Basel Accords would ensure that you are adequately capitalized. But one limitation of the Basel models or of the capital adequacy framework is that they they do not consider the macroeconomic situations in the economy, right? So even if I say that, okay, I'm adequately capitalized and I have used all kinds of data requirements which Basel and CRD4 has suggested, but even there, even in that case, what I have not done is I have not seen how capital, or am I adequately capitalized, not only with respect to that time or that period or during that set of macroeconomic situation or macroeconomic variables or that macroeconomic scenario, but am I adequately capitalized to survive properly if the economy undergoes a downturn? And if the economy, and let us assume that if the economy undergoes a downturn and that downturn persists, so should I be able to handle that downturn period? So do I have sufficient amount of capital, not only such that I'm adequately capitalized, but I also have sufficient amount of capital to overcome the downturn period, right, to survive the macroeconomic downturn. And this becomes very important because of the presence of the GCFs. So what is a GCF? A GCF stands for a globally, systematically important financial institution. And more over these days, we get to see an increase in the number of GCFs. So when the global, so as you have more and more number of globally systematically important financial institutions, right? You need to ensure that the banks are more and more stable. So the requirement of their capital adequacy under stress scenarios increase, right? Because let's say if a Goldman Sachs or a Morgan Stanley or a Citigroup, if it collapses, it can bring a recession worldwide because they have their operations all across the world at different regions, and the amount of employment that they actually provide is not really very less. So they do contribute to a very significant size of the overall population. So it is absolutely it must be ensured that the GCFs or the globally systematically important financial institutions are well protected with an extent of capital, with a large buffer of capital. So even if there is a downturn and there are huge volumes of defaults happening in the banks, on the books of the bank must have sufficient amount of capital so that it can sail through the downturn period, right? And the most stringent definition that these regulatory models say, that what they, especially what CCAR tells us is that, the question that CCAR tries to answer is that can the bank survive a downturn period of 9 quarters with the amount of capital that it has and with the capital distribution plan that it has in mind over these 9 quarters, right? So basically what they want to understand is that will the banks have a certain given capital distribution plan made over the 9 quarters. The question that comes out is that can the bank actually afford to have that capital distribution plan? Can it afford to give out that dividend? And it can only give out that dividend even only if it is sufficiently capitalized to save itself or to survive 9 quarters of downturn. And that is where, to ensure and to double check this, what they do is they put it in 3 layers. So what they do is first they test the bank's capital adequacy under a baseline scenario, then into an adverse scenario, and then to a severely adverse scenario. Under each of these scenarios, what it tries to do is it tries to understand that whether the bank is adequately capitalized or not, and how would they do it. So what do they do under each of these stress scenarios? Under each of these stress scenarios, they stress the balance sheet of the bank and they see how is it that the bank's balance sheet would ideally look like, right? So how would the prediction, so what would be the predicted asset side of the bank under each of these scenarios? And when you are doing this, what you are essentially doing is you are trying to map each component of the balance sheet, each component of the financial statement to a certain macroeconomic scenario. Now, what exactly is a macroeconomic scenario? A macroeconomic scenario is a set of macroeconomic variables and the certain levels of their values. When all the macroeconomic variables are at a certain level, they so when the macroeconomic variables are at a certain level, they together form a macroeconomic scenario, right? So different situations, so they are kind of simulated scenarios. Now, the ultimate question that comes out is that how do the scenario and this prediction and this entire thing of linear regression then relate to each other? Now, before you put a bank into a scenario, right, or the bank's financial statement into the scenario, you need to ensure that each financial statement of the bank or each financial component of the bank in this on the bank's balance sheet and on the bank's PNL statement is represented as a function of the macroeconomic variable. So you have actually modeled them as macroeconomic variable as functions of macroeconomic variables. So when the macroeconomic variables move, right, your balance sheet values will all the balance sheet and your PNL statement values will also be moving. Now, when you are doing this, now if you think about a bank's balance sheet, right, we don't have much of categorical variables out there. The balance sheet and the P&L statement, you have continuous values. So these continuous variables, these continuous dependent variables are related or are mapped to the macroeconomic variables. And when you are trying to develop, when you are trying to assess the causality of these macroeconomic variables to the dependent variable, what we are getting is the macroeconomic model. Now, similar macroeconomic model is also used for IFRS 9, right? Where you have multiple scenarios, and under each scenario you need to compute the ECL. But for stress testing exercises, it's more exhaustive because it's a capital model, right? And these capital models that we built out over here would be used for so there is a capital determination, and hence they are high materiality models, right? So, so in
I,
order to, yeah,
uh,
tell me.
sorry, Natan, would you be able to repeat it as in like, so the final model will be a function of macroeconomic variables, that what
So
you said?
basically, if you have to see how the balance sheet looks like, so each component in the balance sheet and each component in the PNL statement of the bank has to be a function of the macroeconomic variables, right? If they are moving with respect to macroeconomic variables, then you have to develop a model where you have the balance sheets, say the P&L statement items, right? Let's say the interest items, the non-interest items as functions of macroeconomic variables. So when the macroeconomic variables change, these values will also change. So there must be a causality between the macroeconomic variables and the dependent variable, right?
Okay.
So once that relationship is developed, then you put that equation under multiple scenarios, and those scenarios are constructed by giving different macroeconomic with different values of macroeconomic variable, and what you finally end up with is the stressed equation. Now when we are writing this or when we are developing this model, the challenge that comes out over here is to develop or to get this dependent or these financial variables as functions of the macroeconomic variables, right? So this is something, and at the heart of this exercise will be your linear regression models. So let us see how that is going to happen. How is it and what are the challenges that you would face? Because over here only, when we are kind of developing this exercise, right? So when we are doing this, so over here only, what we'll try to do is we try to explore the limitation, the issues of a linear regression model and the generalization, the problems associated with a linear regression model, like autocorrelation, heteroscedasticity, multicollinearity, and so on. Now, another big challenge, just remember this, that when you are using a linear regression to map the financials, the statement, the PNL variables, and the macroeconomic variables, there is a potential challenge in this again. And the challenge over here is that the linear regression is applicable on a cross-section data. Linear regression does not give you very good results where time series variables are involved. And over here, the PNL statement for the bank would be part of a cross-section data, whereas the macroeconomic variables are time series data. So you're trying to create a synthesis between the two, and there are certain challenges arise because of this synthesis which happens. So, but let's try to understand how this stress testing is done, and how is
So,
it that linear regression would come up. Yeah, tell me.
then my quick question.
Yeah, tell me.
When you talk about CCAR models, does it talk about the capital buffer over and above the capital adequacy ratio, or how exactly it works
No,
out?
no, 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 no. It's not a capital buffer. So you have the key regulatory ratios, right? So you have the
Right,
tier 1
right,
capital, you have the tier 2 capital,
exactly.
and then you have the leverage ratio and all these, right?
Right, right.
So CCAR has certain specified limits of these ratios. And
Okay,
what CCAR tries to test is that the amount of capital that you have actually reported in your final balance sheet,
right.
does that does that figure, or is that figure enough for you to survive a downturn? That is, that if I use that capital to compute the regulatory the ratios, right, I should get a value which is greater than or equal to what CCAR prescribes under each scenario.
So,
So I don't remember the exact limits, but I think the CCAR prescribes around, so it has a leverage ratio cutoff of 5% or something like that. So let's say that there is a leverage ratio, right? So leverage ratio and the cutoff is 5% by C, that CCAR has put it. So if I test the amount of tier 1 capital that I have kept back
right.
under a baseline scenario, under downturn and I mean under adverse and a severely adverse scenario, I should always get a capital leverage ratio which is greater than or equal to 5%,
So, which means that even in case of the adverse scenario, it should be over and above the required this thing,
over and
right?
above the required value, right?
Okay,
Right. So
understood.
that's, so the idea of CCAR is that first you keep aside sufficient capital so that you do not crumble down during a downturn, right?
Right.
And then what you do is you kind of do whatever your capital distribution plan is. So in that way, because the CCAR regulations are published by the Federal Reserve, they tend to impact the actual capital distribution plan. Now let's say the bank has decided, okay, we'll give, so let the economy go to hell. What we'll do is we'll give out very attractive dividends to our stakeholders and they'll bring in more investable funds and we'll try to grow with that. So despite our toxic lending portfolio, CCAR is not going to let that happen. So CCAR says that first, whatever lending you do, that has to be absolutely model driven, right? That risk has to be appropriately controlled. Second, if you have done any risky lending, you need to keep aside a risk-weighted asset. So you need to compute the risk-weighted asset that is there, and you need to keep aside a capital corresponding to each RW to each risky lending that you do. So for example, whenever a credit card is lent out, with every credit card, you start incurring a profit in terms of interest, and there's an interest income flow which is created, and at the same time there's an RWA which is booked.
Right.
So so that function always has two things. So any expansion of a credit business comes in with its risk and its returns. Now what CCARs, now what the regulators tell you is fine. You have adhered to Basel, you have kept aside whatever capital is required. Now my question is that, okay, given that capital, you want to go ahead with your plan. But before you go out with your plan, I need to ensure that if there is a downturn, the amount of capital that you kept is sufficient. That is, let's say that if there is a deviation from the baseline scenario. Now, if from the baseline scenario, when I move to the adverse scenario, right? So my economy faces a downturn, and all my macroeconomic variables starts contracting. Now, when this contraction happens, so obviously the portfolios become more risky, delinquencies increase. But do I have sufficient amount of capital to survive that? So do the capital ratios that I have with me at this point of time ensure that I can operate smoothly and I'll not collapse if an adverse scenario arises. So it checks, okay, so these are the cutoffs that must be satisfied. Do you have those cutoffs? Yes. Now the next question is that if there is a severe adverse scenario. So in a layman's language, what is a severe adverse scenario? So it says that, okay, a severe adverse scenario is a period where your adverse scenario has persisted for a long period of time. So let's say your GDP is not growing at all. In fact, there is a negative growth. Your unemployment is absolutely sky high. Your supply curve is absolutely flat. Huge amount of inventories in your economy. Now, in such a situation, your economy is in a liquidity trap. can you survive this situation? Do you have sufficient amount of capital to pull yourself through this situation? Yes. If all the threes are yes, then it says that okay, you have the sufficient amount of capital. Now you can go ahead with whatever you have planned. If the CCAR fails at any stage, at any of these three situations, the Fed will not allow that capital distribution plan of the bank to realize. So let's say I have planned a 10% dividend without giving sufficient amount of capital, and I fail that test. I pass baseline adverse, but I don't pass the severely adverse test. The Federal Reserve will not allow me to take my capital plan or pursue my capital distribution plan. So when CCAR submissions happen, along with the amount of capital that you have kept and all those documents, what also goes out is the capital distribution plan, right, for the next 9 quarters. So, so if it is going for the next 9 quarters, so that's a huge thing, right? So it's 2 years and more. So the next 2 years, whatever the capital distribution plan is, that is what you are trying to look through. So this is how what the stress testing is all about. Now, if I need to know that, so if I want to estimate whether my capital is adequate or not, all my Basel models are there in place. I run my PD model, NCD model, EAD model for each of the portfolios. I get the expected loss. I put it into the RWA formula. I compute my unexpected loss, and I'm done with the capital. Now, if I want to know that when the macroeconomic situation changes, how is the PNL statement of the bank going to look like? How is the balance sheet of the bank going to look like? And given that I see both these two, right? So I from there I would know how much of capital will I need to keep in that period, and if I keep that capital in that period, what is the amount of output that what is the amount? So what would be the regulatory ratios looking like? Now, if I need to do this exercise, I need to incorporate macroeconomic variables into my model. And if I incorporate macroeconomic variables in my model, those are time series variables. Now, when I incorporate these macroeconomic variables and I relate them, or I try to explain my balance sheet variables in terms of these, right? So my balance sheet variables at a point of time are cross-section variables, right? So it's just a variable in the bank's balance sheet. So what I need to do is I need to develop a framework, a regression framework, which will help me associate both of these two together. So now if I think over a period of time, my PNL values will give me a time series, right? Now the question that comes out over here is, let's take a very simple example. Now a bank earns two types of interest, right? One is your interest payment. The other is your one is your interest earnings. The second is your non-interest earnings, right? Now, if there is a, let's say there is a non-interest income of a bank, is an income like a trust fee, right? Or let's say a deposit fee. Now, during downturn, the deposit fee will actually go down. So for maintaining my account annually, the bank charges me a certain fee. So that's a fee income which the bank earns. So it's a non-interest income. Right? So if you are using your credit card, if you maintain a credit card of a bank, then you are actually maintaining, so you have to pay a card annual fee. That's a fee income that the bank earns. Now, during downturn, let's say the GDP of the economy is going down, people are losing their jobs, what will happen to this fee? So this fee will go down because there would be, number one, many existing card holders may sacrifice their cards, right? May give up their cards. New people who are supposed to take the cards will not be taking up the cards. And those who are using the card, so they are existing, right? The existing base goes down and there are no new fresh additions to the base. Hence what happens? What happens as a result of it is that the overall deposit fee of the bank goes down, right? So obviously it is when the macroeconomic variables like GDP, unemployment, interest rate, market volatility and so on, when they change, your dependent variable changes. So this is precisely the model framework. So you need to develop a model which would relate the financial statement and the balance sheet, the financial components in the balance sheet and the PNL items to the macroeconomic variables. So your macroeconomic variables become continuous variables. Your dependent variables of balance sheets or financial statements are your continuous variables, and hence the regression that happens on both of them is the linear regression, right? Because even if there is a downturn, right? So there will be, or even in the upturn, things will not change very exponentially, right? It's not that someone says, okay, downturn is gone, hundreds of people flock together to get credit cards. It's not like that, right? The increase is gradual. Acquisition is a gradual phenomenon. Attrition is a gradual phenomenon. So these variables would generally have a linear relationship or a proportionate relationship to the macroeconomic variables, right?
Then my just
Yeah.
what is like for P if it's a PD stress testing model, in that case, so like it's not a linear regression. Like how will be the PD be in adverse scenario, severe adverse scenario? So,
Yeah, so over there you have the probability of default values, right? So
hmm,
the probability of default itself is a continuous value.
hmm,
So
right.
you have the PD estimates, right? Now, if you have the PD estimates, you will not use the PD estimates again, right? So you will use the log odds. You'll convert that PD series to a log odd series. So log P by 1 minus P, log PD by 1 minus PD. So that log odds is a continuous series. And to that series, you map your macroeconomic variables. But we generally do not do it that way. When you are doing a stress testing exercise, you have your financial statement heads, you have your balance sheet heads, and they are continuous variables, right? And to them, what you do is you map your macroeconomic models. And at a PD level, if you want to adjust your PD, so you adjust the PD with your macroeconomic variables when you are doing a point in time or to through the cycle conversion and so on. So we'll come to that part later.
Okay. Okay.
So we'll talk about the PD class of things when we are talking about the the logistic models. So let's focus on let's focus on the continuous variables in the banking industry. So let's look into the PNL statement, how the PNL statement is constructed, how is it that uh, the balance sheet is constructed, and so on. So that is something that we need to think about, right? Okay. So let's think about it this way.
And then my one thing, like will the this course see the way you are explaining the regulatory framework, how is it evolving, and then the
Mhm.
similar way, like when we go to the like do we get to do like hands-on, like developing one
Yeah,
CCAR
I'll
model,
do
Basel
hands-on in each
model?
of these regulations. Yeah, I'll do hands-on on each of these regulations.
Okay, so like different scenarios, how we calculate, so that
Different, right?
everything.
Correct, correct,
Okay, okay.
correct. So, but I don't think the scenario analysis will be possible. So, scenario analysis, I'll just talk about how scenario analysis is done, because for scenario analysis there has to be time series which has to be discussed at length, right? I don't want to do that. I'll restrict myself to the regression frameworks over here in this particular discussions. So we'll talk about all type of regression frameworks, but we'll not be talking about time series as a framework, because time series will be a very comprehensive, it itself is a very comprehensive thing and it becomes a bit challenging. So I don't suppose we'll be covering time series, but yes, I'll be talking about scenarios and I'll go deep into these regulations. But as of now, what I'll be talking about is that how is linear regression applied to CCAR and DFAS. Right. So I'll just be talking about it from that aspect at this point of time. Okay. Okay. So a bank's financial statement will have two very broad components. Bank's financial statements. 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 So it will comprise of two things. It comprises generally of two things. One is a profit and loss statement. A profit and loss statement, or as we call it, the PNL statement. Right. So I have a profit and loss statement, and what I also have is a balance sheet. Now these are two very critical parts. A balance sheet. Now PNL statement. So what does the PNL statement contain? So all of us knows this part. So my PNL statement will give me an idea about my income, and expenditure. So it will give me an idea about the income and the expenditure statement. And what is the final outcome of this income and expenditure statement? The final outcome of the statement is the net profit. The net profit. Right? And what does the balance sheet do? The balance sheet always balances. Now the balance sheet is comprised of two parts. On one side, we have the assets of the bank. So whatever assets the bank has, assets in form of cash, physical assets, and any other kind of assets and anything. So that is, so those are, this is the asset side. And this part that I have over here is the capital side. So the capital side, or on the other side, we have the liabilities plus the capital. Liability plus capital. And this capital that I am talking about again has two parts. What are the two parts? One is your tier 1 capital, other that I have over here is the tier 2 capital. Right. So this is what the form, or this is what the overview of the bank's financial structure is. So on one side, I have the profit and loss statement, which gives me the net profit. On the other hand, I have the balance sheet, asset liability plus assets and liability plus capital on asset on one side, liability plus capital on the other, right? And the capital itself comprises of tier 1 capital and tier 2 capital, right? Now the next part that I have over here is, so what is the outcome of the balance sheet? The outcome of the balance sheet is assets is equal to liability plus capital. So I have this as the outcome of the balance sheet. Asset equals to liability plus capital. And on the other side, it has net profit. Now, now this is where the role of macroeconomic variables come in, right, under stress testing. And I want to know that as the situation in my economy deteriorates, how does this net profit change? How does it starts looking like? So does it get converted into net loss? Does this asset side squeeze totally? Liability gone for a toss. So liability is sky high, assets are low. So can capital help me offset that? So do I have a sufficient amount of capital which can help me run that capital down and run my day-to-day business without crashing? Now, why is crashing such an issue for big banks? Now, especially in the US, when a bank actually collapses, right, it is actually bailed out by the government, and that's the case in any other countries. But bailing it out in US is a different story altogether. The idea over there is that in US, if you are actually bailing it out, you do it with the common people, the taxpayers' money. And people are really very politically conscious out there. And when they see the government is wasting the taxpayers' money in bailing out big banks without properly regulating them, and instead that money would have had opportunity cost for them, and it would have been used for their welfare. When they see these kind of imbalances happening in the economy, then they tend to vote out the government in the next elections. It does not really work the way it happens in India. So that is why, assets. So that is the reason why, in this balance sheet you need to have this assets, liabilities, and capital. So one thing that we need to have it over here is that they need to ensure. So these banks need to ensure that even if if the macroeconomic collapses, the banks should have sufficient amount of capital so that they can pass through that period. Right? Now comes the next part. The PNL statement. So how would this PNL statement of the bank generally look like? So the PNL statement that I'm drawing is from my last memories of my accounts textbook. So if you generally see your financial statement of your financial statement of your bank being published in a different manner, then just know that, but the heads will be more or less similar. So this is, let's say, the income side. the expenditure side, right? So I have the income and I have the expenditure. Now, how does the income side look like? The income side has two broad components to it. Okay. So let's talk about the income in a PNL statement. So if I talk about the PNL, so you have two parts. One is the income. The second is your expenditure. Now, how does the income of a bank statement look like? The income contains it consists of two parts. One is your interest income, interest income. The next that we have over here is non-interest income. I have the non-interest. Now, an interest income is the income that we receive from the interest earned. Interest earned. And so this is from one possibility is from loans, cards, and so other bonds which has been so bonds where this particular bank has invested in and so on, bonds and other such assets, right? Loans, cards, bonds, and so on. So we have the interest earned in these parts. Now, if you have a look into this component, the interest earned component. Now, this interest itself is dependent on the repayment capability, right? And depending on its exposure, you can have the events of delinquencies arising in case of right. So delinquency in terms of delinquency would increase during periods of downturns, right? So over here, delinquency increases with downturn. The delinquency increases with downturn period. So over here, I need to assess this interest earned or this interest that the bank is actually earning in terms of three periods again. So this interest earned is assessed in terms of three periods. How would it look like in the baseline? So in the baseline, it will be the highest because the people would the chance of the borrowers to default would be the lowest. I mean, on an average. Then comes adverse. The other is severely adverse. Now, under each of these scenarios, I need to know how is it that the interest earned from each of these loans will change. Now, if you further think about it, you'll see that depending on the loan that is there from which the interest flow is coming, the role of macroeconomic variables, underlying macroeconomic variables increase significantly. Let's say it's an auto loan portfolio for the bank, right? Now, if it's an auto loan portfolio, there will be several factors which will impact the interest income during downturn or during adverse and severely adverse periods, right?
Then
Yeah,
how we define this at periods like severely adverse period, like
I'm
what
coming
is
to
it?
those definitions. I'm coming to the definitions.
Okay.
Just let me get the relationship clear and then I'll come to those definitions.
Okay.
Okay. Guys, just give me a minute's time. I'll just come back and I'll get started. Give me a minute. Okay, okay, sorry. So as I was saying, uh, so the question that comes out over here is that how is it that this, you know, this interest income gets affected? So when I go to answer this question, that how is it that this interest income is affected? So I need to, so if I do this, so basically think about it. Let's say I'm giving an auto loan, right? What I'll do is with that interest income which I earn from the auto loan, I would ideally put it under the baseline scenario and I'll see how that interest rate is. I'll put it under the adverse scenario, I'll see how it is. I'll put it under the severely adverse scenario, right? So one thing, rightly as Devashmita had asked, we need to first of all define these three scenarios, right? So CCAR has very specific definitions of these baseline adverse and severely adverse scenarios. So I am not going into that exact details. I need to just look it up once from the CCAR documents. I'll tell it to you tomorrow, the exact specification of these scenarios. But let me give you a brief outline of what these scenarios are. So when I talk about a baseline scenario is a very average scenario. So this is a very average scenario, which, or you can say the long run growth path of the long run values of the variables. So it is created with the long run or the most average values of the variable. So this is a very average or a very normal scenario. So this is not a period of very high growth, neither is it a period of very low growth. So moderately, right? Let's say if it's for the Indian economy, let's say the GDP grows at around 7%, 6.57%, right? So that's the average growth or the long run growth that you have seen in this scenario. So that's the baseline scenario. So this is your average scenario. And all the values have, or most of the variables have, the long run average values. Now when I talk about scenario, guys, a scenario is just a representative recreation of a macroeconomic situation, right? It is not a set of predicted values, rather they are a set of simulated values, right? Now from the baseline model, now if you are going a downturn, so that is called an adverse scenario. So if I were to plot something like this, if I were to plot something like this, let's say GDP, this is time, and this is, let's say, GDP, right? So all of us are aware of GDP, right? And this is something which is doing the round in the Indian medias of late. And downturn is also something which is very well known to everyone, right? So we have all been witnessing this downturn in the automobile industry, right? So for obviously for which millennials have been kind of appointed as guilty. So whatever. So we have all been identifying that downturn periods, right? Now over here, how do we define this downturn then? How does this go about? Now, to define a downturn, or let's say an adverse or a severely adverse point, you always need a line of reference, and that reference is always your long run growth path. Your long run growth path or your long run average, right? Now, in reality, what happens is that the things they happen, they tend to generally deviate from this long run growth path, something like this, right? So it appears something like this. Now when I have a look into this, So this part, if I if I look into this, so this part is a downturn, right? So your GDP has been positive, but it goes it is it is going down for say 2-3 quarters, right? So it goes down for 2-3 quarters. So you know that your product, the overall size of the economic activity in your economic geography is kind of reducing. So that symbolizes a downturn, right? So I can show you an example over here. So this is one of the work which I was doing of late. I cannot share this with you though, but I'll just show a few part of this with you. I'll share some part of this with you.
But that LRGP is that baseline, right?
The long run growth path, right?
Yes.
Okay, so this is a set of macroeconomic analysis which I am doing presently for one of the clients in the Middle East. So if you have a look in this, you will see that. So over here, what I have done is I have plotted the growth percentage and the inflation percentage, right? Now, over here, if you look into this plot, right? So if I draw a straight line, a long run trend over here, so I'll always get a long run trend value. Now, how would a downturn look like? So have a look in here. So this is 2001, 2002, and 2003. The GDP of this particular region is right at the peak. Now it starts falling, and you get to see that at the annual level, we see that it has fallen for 2 years, right? A slight rise, and then the downfall continues until it reaches a trough at the like a value which is below 1%. So it goes down to as low as 0.79%. So over here you will see that for continuous 3-4 years, the GDP has been sliding down. So if you plot, let's say this plot was on a quarterly basis, then a downslide for 3-4 quarters at a stretch will be a downturn. So the base data that I used to simulate my adverse scenario for GDP and for other variables will be a period when this is undergoing a downturn, right? So a adverse situation, right? An adverse situation is a simple downturn, right? So when I talk about an adverse scenario, I am actually talking about an ensuing downturn. It is not a severe recession or a depression of the sort, but it is a situation where your key macroeconomic variables are undergoing a downsizing. So the overall size of the economic activity in your economy is reducing, right? So this represents a downturn period. This represents a downturn period. So I have a baseline period. There is an adverse period, which is your downturn. Now, any downturn is not always a recession, because we always tend to think, that okay, there is a downturn means there is a recession. And I have received this question multiple number of times, right? When people tell me for Basel model development that 2008 is a very distant time and today is 2019, 11 years. So do we need 11 to 12 years of data to incorporate a downturn? But that's not necessary, right? So 2008 was a period of a recession. It was not only a period of a downturn, it was a severe downturn, right? So it was downturn in its extreme form, and this is where this particular thing. So this is where this particular thing comes in, right? So over there, what you get to see is that you have so you have extreme slides in your productivity of the nation, in the unemployment, and so on. So when I talk about a downturn is where your uh, economy has just started contracting. It is not somewhere. where it is right at the trough. So that trough that I am talking about, that 2008 is not an adverse period. It is that severely adverse scenario which CCAR talks about. A severely adverse scenario. Severely adverse scenario. So this is something that we need to address. Now, how do I then define a severely adverse scenario? Now, a severely adverse scenario is defined as a situation where your economy is growing at a negative rate. So basically, what has happened is your GDP is now negative, right? So you are not producing anything additional. So your economic activity has gone down to zero and has trashed out the zero limit now. So the real GDP growth is just negative. So how would that particular economy look like? And what does this severely adverse scenario mean? Now I'll explain this concept to you in a very simple manner. So we have all studied demand and supply, right? So we all know how a demand curve looks like, how a supply curve looks like. Now, when an economy is at the severely or is undergoing a severely adverse scenario or facing a severely adverse scenario, so let's say this is 0, this is the price, and this is the output. I'll just identify output as Y, right? So your supply curve looks something like this. This is your aggregate supply curve. So your aggregate supply curve does not change at any level of output. So given a price, at a price level, it remains horizontal. Now this is a very critical situation in an economy because, so let's say these are your demand curves. These are your demand curves. Now what is happening in this severely adverse situation then? So whatever the demand is there, it is being met at with whatever the economy has, and there is no additional production. Now, if there is no additional production in an economy, right, your unemployment rate will keep on increasing. So there will be a free growth of your unemployment rate. So what has happened over here? It means that the economy is like, it is so, the demand in the economy is so low that whatever the demand the people has is being met with the inventory accumulation that we have. The similar situation in the automobile industry in India that we have now. So I don't know whether you guys have seen this news. Very recently, Maruti or I think Hyundai, whoever. So out of these two, anyone had shut down their production plant for 2 days. For 2 days, there was no production. What it implies is that in the inventory there is so much of unsold stuff which is there, right, because of which the people cannot because of the fact that people are not buying things, the inventory is not getting cleared out. Now they don't want to maintain the added inventory cost. So what is happening to the automobile industry's PNL statement? Their inventory costs are going up, so the expenditure is going up, and in the income side their sales turnover are going down, right? And that's how the PNL statement of the Maruti and Hyundai are getting stressed. So in a stress situation, you will see that your expenditures are increasing and your income is decreasing, and that's where your stressed situation comes in. So over here, in this particular situation, when the economy supply curve is absolutely horizontal, it means that whatever goods I have in the basket, in the inventory, that is good enough for me to meet the added demands. I don't need to produce anything. So what it implies vice versa is that your unemployment is at a sky high rate, and that's an absolutely involuntary unemployment. It's not that you have sufficient opportunities and some people don't are not working. It's that people are not working because they don't have the work. So they don't have sufficient job opportunities. Production in the economy has been curtailed, right? And that is precisely what your severely adverse economy is. So the downturn that we are now experiencing, right, in India, it comprises of two parts. One is a cyclical part, which was the normal downturn, and the other is, and that is aggravated by certain downsizing in certain key industries, right? In India, the automobile industry is what the real estate economy, the real estate sector is to USA. So whenever your economy grows, it is the growth is reflected in two segments in India. One is the real estate, on the second is your automobile. So when the people's income increase, people over here tend to buy cars or they tend to change their cars, right? So so if you look into this situation that India is now presently, right, the GDP has been falling down for last successive, I think 6 quarters now at a stretch. 4 quarters last year, the GDP had gone down, and the last 2 quarters this year, it has gone down. So 5, 6 quarters at a stretch had been going down, right? And so this is a period where your downturn had already initiated. If it is continuing for more than 3 quarters or 4 quarters, you know that there is something severe which is going, something dangerous is happening in your economy, and it is now moving out from an adverse situation to a severely adverse situation. And in the second stage of these of an intensifying downturn, you will see reduced production, increased unemployment. Now, if you go back 1 year, right, 1 year back, right from today, in India, you would see that the GDP was going down, right? So it had fallen down from what it was from its 8.5 that it was growing a few years back. So it had gone down, right? But it was maintaining a steady thing. And over here, now what it has happened is it has just taken a free swing. Now, after your GDP has gone down for certain time, for some period of time, the next impact moves on to the stock markets, and you see the stock markets has been falling down, and that is coupled with a free flow in the currency purchasing power parity, right? In the exchange rates, the exchange rates have also deteriorated. So one thing that you can clearly see is that all these three together are going down one by one together, right? So if I have to replicate a severely adverse scenario, and sorry, and one very critical thing, finally the real sector, the production sector takes a hit, and now you are seeing that downturn being spilled onto the automobile sector, and gradually it will flow to other sectors, because the automobile sector is something which has a huge linkage effect, right? So to it, there are very other smaller industries who produce, who cater to those goods, like who, who, uh, who manufacture rubber to them, or say some kind of other car parts, materials, and stuff like that, who produce it to the car manufacturers. Now, once the production is stopped for 2 days, 3 days session at a trot, the people who are involved with the automobile industry will also suffer a dead loss, right? And that is where the downturn will intensify more, because with each sector, if you think with each large sector, the manufacturing sectors especially, there are a whole set of ancillary industries. So in a downturn situation, right, the ancillary industries are not initially hit, but once that hit takes to the, once that toll takes to the key manufacturer, all the other ancillary industries are also shocked, right? So they also feel that ripple, and the unemployment starts increasing in manifolds, right? And that is why if you look into the unemployment data in India as of today, you will see a substantial increase. So now with these things happening, how does it impact the banks? Now with the banks, the NPAs are going to rise. Why? Because I was working with, say Maruti, and I was the zonal manager, Maruti stopped production for let's say the next 2 months. They don't want to keep me as the zonal manager. They just kick me out of the job. So very recently, right, you saw that the news that Parle-G is one of the largest biscuit manufacturing companies, but they have laid down 10,000 people, and that's a huge report, right? Because of the fact that there was no production, there is no revenue, and hence these people are laid off. Now think about the fact that the manager of a production plant over there, who earns around 60-70,000 bucks a month, had a credit card with the bank, he's thrown out of the job, he's not getting the job anywhere else, and hence what happens is he can't pay his credit card bills now. So obviously, if he cannot pay his credit card bills, the interest of the bank is short. The interest income gets short. The you know the so he cannot pay his car EMIs. That gets short. So the bank's financial statement also starts get feeling that ripples of the shocks coming down. And again, there will be spillover impacts, right? So let's say when this manager loses his job, he doesn't have a job, he'll not be taking his family for regular medical checkups. So as such, the diagnostic firm which had taken the loan from this bank XYZ will also not be able to pay his dues to the bank. And hence, again, due to this spillover impact, the bank's commercial portfolio is also going to get impacted, right? And hence, through this channel, the and through this channel, the income of the bank, the income statement starts getting stressed, and the more stringent the macroeconomic situation starts becoming, the greater the impact is felt on the income. Now, with the income going down relatively during this downturn and like adverse and severely adverse situations, the expenditure relatively also increases. Why? Because credit for the banks become more expensive, right? Access to credit becomes more difficult. So they have to, so if the bank requires any credit for or any interbank credit, that has to be taken at a greater rate, at a higher rate. So that expenditure of the bank increases. Some operating expenses of the bank remains unchanged, right? And with sudden flowing down, the banks, to take care of its operating expenses, would lay off certain divisions, certain parts, right? And hence, this way, the unemployment gets even more acute. So at each stage, right, if you look into this entire cycle or into this entire circle, you will see that it is these macroeconomic movements which is impacting the balance sheets all across the economies, and hence a relationship of these heads now needs to be developed. So a link now needs to be developed between these variables and the macroeconomic variables, right? So is this chain or is this occurrence clear to us now? Any questions up to this point? Perfect. Perfect. as I was saying, so coming back, so one thing now is clear is that how is these macroeconomic variables related to the, so how should they be related in order to stress test the bank's capital? Now comes the next part. Now, apart from the interest income which the banks earn, the bank also has a set of non-interest income as we had talked about, and which is the fee charges, fines, etc. Penalty, etc. Right? Now, these are also impacted by macroeconomic variables. And depending on the different income heads, the impact or the importance of the macroeconomic variables become very important. Right? So it becomes very important for us to understand how is it that these macroeconomic variables can be interpreted, or which variable will have a greater macroeconomic variable. So, or which macro variable will have a greater impact on the or a particular income head. So this is something that we next need to address. So following other two questions now. Next is, what are the key macroeconomic variables, right? And given a set of macroeconomic variables, how is it that we can zero down on a set of final macroeconomic variables explaining a particular income head in the balance sheet and in the income expenditure statement? And this is the part that we discuss in tomorrow's session. And when we discuss this part, we'll talk about how the regression models are developed, or how is it that this regression model will work. Once we have selected the final variables, from there we'll start looking into the model variables, right?
Then this macroeconomic variables are associated with the interest income only.
No, we'll talk about both in terms of interest and non-interest income. So macroeconomic variables impact both.
Okay, acha, okay. If they defaults in the downturn period, generally like
Right.
more fees. Okay, got it.
Correct, correct. So we'll see how the impact and how is it that this stress testing regulation is implemented. So we'll see that. So today, in today's session, I give you the background to it. Tomorrow we'll talk about the implementation side of it. Thank you. Bye bye. Have a great day. I'll share the recording today. Thank you. Bye bye.